Good morning, folks. We're going to take a couple examples from last week's price action using the scalping method that I taught you. All right, so before we begin, we go to our daily chart and we're going to look at the fiber first. And I'm going to put my little tools here so you guys can use this as a means of determining your bias. All right, so I have three tools here. It's a down arrow, an up arrow, and a small little trend line segment. And I'm not going to be teaching you trend line analysis, okay? But I will be teaching you how to keep your focus on a specific bias. And we go to our daily chart to do that. And if we're bullish or bearish, it has to be a method in which to, number one, define it in very constant terms that don't deviate, that don't change or morph across the longer you do it. But we're looking at a condition in the euro where we have a swing high right here, swing high, and that swing high has been broken right here. Okay, so once we have a swing high broken, the condition is we wait for a swing low to form. And it takes patience, I know, but you want to find the most likely conditions or odds in your favor to look for trades, and this is what you do. Okay, so a lot of times traders are spending waiting for their condition and setup, not trying to find perfect settings or a new method because they don't have a trade today. If you submit to this idea, I promise you, you will find consistency and you will find all the setups that you'll ever need. But that's for you to decide and figure out on your own. I can't convince you of it outside of just inviting you to test it, and you'll see it for yourself. So now we have our condition here. We have a swing high broken, and then we wait for a swing low to form. So now what we've done is we've allowed the market to show willingness to rally or show strength. Then a retracement swing low forms. Once we have that swing low right in here, we go into the marketplace and we look for previous day's highs and old highs. And that's how we frame our setups. Now, once you have your line segment on here on MT4, you just highlight it, hold down the control button, click and drag it away. You can copy it. Okay, right in there. So now we have our scenario for a setup for this past week. This would have been one good setup to look for, and I'm not trying to teach you one shot, one kill. I'm not teaching you the opening on the week to get the weekly range. I'm not teaching you all those things. I'm not teaching you power 3. I'm only teaching you a small little segment of price action to study over and over and over again each week, and you'll find that there are very generic, simple setups that form like clockwork. Every single week, you'll find them. They're bread and butter concepts. So now we have our framework on the daily chart. So we know from this day's close here on the 22nd, we're bullish, and we're going to be looking for a run on the liquidity above this particular high, and it's the 15th of November 2017. So now we can take our information that we have here and simply drop down into an hourly chart. All right, so we have our euro dollar, and we're on the hourly chart. And our delineations on where the liquidity run is going to be is here. And I'll add the day dividers. Hold down Control Tab Y. You'll get these vertical lines delineating the individual days of the week when you're on an hourly chart. So that takes us right into this area right here because we're just below this old high. So we're going to zoom in on that. So all in here, that's where the setup would reside for a short-term scalp that would take us above this old high. Notice also on this day, we have already cleared the previous day's high. So we're already above it. So it's going to most likely continue forward in upward motion or momentum to take out the high, which it actually doesn't do this day, but generally if you start the day above the previous day's high in the New York session, it's going to be a straight run. But in here, I'm going to give you the context of what we look for, or what I look for scalping. This is one of my earliest forms of scalping. It has evolved over time, but it's a really good foundation. So in this particular day here, we're going to look at, I'm going to drag this over here so I can zoom into a 15-minute time frame. It'll take me right into that period of time. Okay, and you can see there's really no clear discernible impulse swing on this particular day. It just goes sideways. So this is a day where we cannot really take a trade because it doesn't have a clear run, impulse swing, and then want to retrace for an optimal trade entry. Really tight little consolidation range. And the very next day, we see Friday's trading. Okay, and I use session highs and session lows, and here is the London session from the previous day. And then we have this swing high here that forms during, what is that? Right before midnight in New York. It just so happens to be a swing high. So we're going to take the low in London. Okay, here is that for the ICT kill zone for London. We're drawing it up to the swing high. Now, there's a whole lot of price action in here. Okay, so we disregard all this, and on a higher time frame, this could be just basically one or a few candles because its entire range is elongated. All of this movement up takes us into looking for a scenario for a scalp. Now this would be an area where we could look for the setup. It just happens to form during the London Open kill zone, which is not beneficial for the system because the system is designed to look for specific criteria in the New York Open kill zone. So that means we have to be looking for the setup to form post 7 a.m. New York time. Okay, so here we have 7 o'clock in the morning on Friday. We have our range. This is where we would originally be hunting. And it doesn't get back down there. It trades back down into an old high. And I'll take this off now. And I'm going to go into this price action right here. I already showed you on Twitter there was a clear optimal trade entry on running the fib from 118.50 to this price swing high here. So if we look for, we're going to zoom in. All right, so we're zoomed in on the 5-minute chart because we can't get an impulse swing on the 15-minute time frame. And we have 7 o'clock in the morning New York time. So now we can go in and look for swing lows to anchor from that show an energetic movement away or rally. We have a swing low that does that here. Look at the energy away from that level. So the lowest body in that swing low, we reference that low up to high right here. And at 7 o'clock, it opens at optimal trade entry. We could be a buyer there or any time prior to this high being taken out on the upside. So anywhere between this high down into this level here. So how's that for logic? We do not need precision entries. Now we can have precision entries, but you don't have to have them. So anywhere in here, you can be a buyer. We will be using the movement above this high for profit. And then also we will be looking for upside objectives to reach for in terms of liquidity. So where could we reasonably expect this to go to? If we're going to be a buyer in this shaded area using optimal trade entry and for a scalp, where do we take profits at? Well, we can take it at symmetrical price swing. Target 2, target 1 is well, think about it. If we bought it in here with the expectation that we're going to run these equal highs, it could only go up 10 to 20 pips. So we want to be at least allowing the market to move in our favor because we're trading with higher time frame directional bias based on that daily time frame. So we're working off of a swing low on daily, and it could potentially have a large range today, which happens to be the case on past Friday. But where are we reaching for? What's the level that we would reasonably expect to see price reach for? We're going to go back out to an hourly chart because we've already framed an area where we would reasonably expect a low risk entry, and you'd have to define the risk with this swing low. So anywhere in here, you'd have to calibrate your leverage on how much you're buying in relative terms to this low, because your stop needs to be at that low. So anywhere up here, the higher you go away from the optimal trade entry, 62 to 79% retracement level, you're going to have to lower your leverage because it's going to have a great impact on what you have in terms of a stop loss here. Let's go back out to an hourly. Okay, we're on an hourly chart. I'm going to just drop a horizontal line on this old high back here because that's where a clear area of liquidity would be. So that would be a very easy, logical area to look for buy stops. So now we can drop back down into that 5-minute chart. So now we have our old hourly high right here. And above these equal highs, we would reasonably expect to see it trade 10 to 20 pips. Watch the little number on the right-hand side. Okay, it's showing 20 right there. So we have 20 pips above these equal highs. It takes us at essentially target 2 on the fib. But then we have this old hourly high here. So we're going to look for a run of 20 pips above that. Okay, that takes us right in here and in close proximity to the symmetrical price swing. So like just pure static price action alone could give us a reasonable objective to reach for that. So in terms of profit potential, let's assume that we got in here on an order block right here, down close candle. You could be a buyer right in here. And say we got with the spread, we got in at that point there. To get to the symmetrical price swing, it's 39 pips. If we go to just the 20 pips above the old hourly high, it's 35 pips. So that's how we would frame a 30 pips setup for the week. And I taught that you only need about 23 pips at 2% risk per week to make 6% compounded a month, which more than doubles your money every single year. And that's all that you need. That is the setup. That's it. That's all that would be necessary. You do not need this entire run all the way for the rest of the day. That's day trading. What I'm showing you and teaching you was a scalping concept, looking for 20 to 30 pips. That to me is a scalp. Technically, anything less than a 50 pip run is a scalp for me. But real easy way of framing the condition, looking for the setups, and looking for the liquidity that the market will reach for. Let's take a look at the cable. All right, so we're looking at the British pound versus the US dollar, or cable. And the same thing, we're going to be looking for a swing high right here. And we're going to delineate that with our little trend line. Okay, and again, what I'm denoting is the fact that we broke through that swing high. So now short-term momentum is bullish. Okay, it's real easy. We don't need moving averages. We don't need trend lines. Not in the sense of diagonal trend lines, but I like to use horizontal lines for noting specific price levels. Okay, so after this swing high is broken, it means this candle right here is the first time it breaks through. It doesn't need to close above it. It just needs to trade through it. Once that occurs, we start going in and looking for swing lows. That's here. So we have a swing low form here. Immediately, as soon as that happens, we start the very next day looking for an opportunity to hunt long positions. Okay, we drag our little tool here and drop it right on that candle, so that way when we drop into our lower time frame hourly, it'll pick up the price action in our chart right away at that candle. So now at this moment, we're looking for bullishness on the 22nd. Okay, before we drop into those lower time frames, I want to delineate the reference points for the liquidity we would probably reach for. And we're going to use, now this swing high here has been broken. That sets the stage for the bias. So going back a little bit further, we have an old high here. We'll use that one. That's our liquidity run. So that's where the target is. And we're going to drop down now into a hourly chart. Okay, so we have our cable trade idea, looking for longs. And on the 22nd, we're hunting an optimal trade entry long. And that's going to take us into, this low comes in exactly at the New York Open. And we're going to be using this low. Why? Because in this area here of price action, this is where the most energetic price action took place on the long side. So there was buying in there. So we take our fib. And again, all I'm referencing is this big move here. Plus, it takes out a short-term high. So we know for optimal trade entry purposes, we have our market structure shift again as well. You can see we trade right down into optimal trade entry right here during the New York Open kill zone on the 22nd, as the method dictates that we should be looking for. I'm just going to shade that little area in. And as a cable trader, you would be a buyer on this particular day here. And we can see we're aiming for this old high on the hourly for a run on liquidity. And target 2 is our fib level. Okay, so we have a confluence above this red level from the hourly, which is an old high. It's also a 20 level. So let's calibrate that down to 20. So 33.20. So we could look for a 10 to 20 pip run above 33.20. And that would be upwards of 133.40 or 133.30. Okay. So we have our setup for that. And we're going to drop down in to a continuation of that same theme. This old high previous day on Friday. So we're going to be looking for a run on this previous day's high, again in the same vein of 10 to 20 pips above. We're looking for. So we have 20 pips above that would be right there. Okay, so that'd be an objective to reach for liquidity. As price starts to drop down here, okay, we're looking for an opportunity to go long. Now, this is London, so we can't use that. Price starts to rally again on Friday. Again, we're looking for this momentum movement above 33.30. So we're going to look at a 15-minute time frame here on the 24th for a continuation of the same theme, looking for bullish scalps. Okay, so we have our chart on Friday for cable. It's a 15-minute time frame, and we don't see the New York Open until right here. Okay, so on this candle right there. So price has already made a swing low. It's starting to rally up. We could look for a scenario like this. And this is still a viable setup. Most energetic price movement prior to that is here. And we'll use that lowest body reference point right there. Then we have the highest reference point. So here is our impulse leg up. Yes, it goes above the old high, but again, we're anticipating 10 to 20 pips. So this is a little flirtatious run above the old high on the hourly, or previous day's high rather. And this day, on Thursday, we have a new previous day's high, and we could take that same element of looking 10 to 20 pips above, We add it here, right there. So now we have a reference point again. And in that case, we don't have Thursday's liquidity ran out at all yet. It's fallen short. But the previous day's high, we are seeing that. That's why you're seeing that little bit of retracement. Right in here, this is where you'd be looking to get the setup, but it has to happen during the New York open kill zone. In this case, we're 15 minutes early. This candle here starts it, but we are below the old high, so we could be a buyer in here. Stop would be below this low here. Price runs to target 2. Look at the bodies of the candles. They're respecting that Fibonacci level, not because of the magic of Fibonacci, but because we're looking for an algorithmic basis to why price should go up 20 pips above a previous day's high. Don't think that I'm having this rectangle over here for any relationship to that particular day. It's this Thursday's high. Okay, so price is going to want to reach up into that 10 to 20 pip range above an old high. And you can see we have a real good respect of that level here. But buying here, essentially around that 33.25 level, it's 10, 20, it's about 20 pipper. You can get 20 pips out of that. So that's a nice little scalp. So it's not barn burner. It's not a earth-shattering amount of pips, but it is a bread and butter setup using the criteria. And again, not demanding absolute precision. You can still take the setup as long as we're below the swing high, and the conditions that leads to the draw on price permits enough range to make a profit. It has to do at least 20 pips or more in terms of potential profit. And if it does that, it doesn't matter where you are in reference to where the old low is for the optimal trade or origination. In other words, where the real lowest risk would be entering down here, which was early. It was before the New York kill zone, which is 7 o'clock in the morning, New York time. With this move already underway here, we can't go back and say, oh, well, I want to buy down here because it's up here. But nothing's changed with the setup. It just means that you didn't get the good entry point, and this is just as good, and you're below the reference point high as we framed the fib. So it allows you as a developing trader to grow in your precision and grow into your efficiency in terms of using the tools and concepts, and then you can anticipate these better levels here on the basis of a limit order that if it was in place overnight, it would have filled you at that price level, and then you would have had a better fill and a better exit point using 10 to 20 pips above the previous day's high. All right, folks, so hopefully you found these two examples insightful. I recommend you go through the price action on all the majors and take a look at the crosses, and you'll see that there are setups that repeat themselves. And notice that while we didn't have a good setup on the euro dollar every single day or the cable every single day, when the conditions are there and we understand what we're looking for in the bias of the marketplace, we're trying to be a buyer or a seller based on that daily time frame, and a break of swing high and then a swing low forms, or if we see a swing low break and we wait for a swing high to form. Those two conditions are setting up our bias. Once that happens, then we go through and look for old highs, previous day's highs, and make a run for liquidity. And it repeats itself every single trading week. It doesn't give you a setup every single day. Don't aim for it to happen in your favorite pair like that, but look for one good bread and butter setup, frame it on the context, and create a demo account and practice for about 3 to 6 months and see if you don't find these setups every single week. Try to find just one. Risk a maximum of 2% and see if you're not getting 6% every single month. If you can do that consistently for 6 months, that's, in my opinion, it's the foundation to would eventually lead you on your own timing and your own decision to move to live funds. I don't tell anyone when to do that. It's a unique personal decision. But when you make that decision, you need to know what you're doing with your live account, because if you haven't made adjustments and developed good habits in a demo account, you're going to discover you can become very reckless and emotional in live trading. So hopefully you found this insightful. And until next time, I wish you good luck and good trading.